Thank you, everybody. Good morning. Everybody looks chipper today. It was great mulling around and talking with many of you. I hope to do some more of that after our keynote speaker and our panel. Rich covered everything that really I wanted to cover, except that I hope that you'll also, as the panel is speaking, you are thinking of questions of interest to you, and that you'll be thinking at the end of the event of ways that we might improve it should we do it again in the future. So with that, I'd like to introduce our keynote speaker. We are pleased and honored today to have with us one of the most respected world leaders in insurance, literally one of the leaders on the planet. She has worked for some of the most respected names of insurance, starting with Prudential, GE Insurance Solutions, Zurich, Canopius, and finally as the CEO of Lloyds. This is a special honor for me. I would also like to point out that she serves as a member of the UK government's Financial Stability and Trade Investment Board, the London Mayor's Business Advisory Board, and this year she joined the UK Chartered Insurance Institute. So it is an honor for me, for the SLA, to welcome Inga Beale.
Thank you. Thanks. Pleasure to be here. And good morning, everybody. This is my second visit to San Francisco this year. Rarely do I actually make it out here, twice in a year. But I'm hoping that this visit will be a little bit calmer, because the last time I was here in June, I was part of the Geneva Association General Assembly. And that is a gathering of about 80 of the top, or the CEOs of the largest 80 insurers around the world. And we gathered here only to be disturbed by the Unfriend Coal Brigade, who then decided to make protests throughout our entire conference, and there were a lot of security issues around the place. So I'm hoping that my 2 days here, we're not going to encounter any protesters outside this building. But it really, anyway, is a true pleasure to be here and to represent Lloyds, because Lloyds has a very, very special connection with this place. Many of you will know that the US is the biggest and most important market for Lloyds, last year making up 44% of the global premiums that all the syndicates wrote. And that means more than $16 billion of premium just from the US. More than half of it's property insurance and reinsurance, but we've also, of course, been pioneering new forms of cover, such as cyber, and we were the first insurer to offer D&O. We're still writing D&O here. We're writing E&O, aviation, and terrorism, as well as many other lines of coverage. And we are the leading writer of E&S business here, and that is growing. For Lloyds, despite some pretty tricky trading conditions that there are at the moment. Lloyds grew 6% in 2015 and then another 11% last year. And we've got surplus lines authorizations in all 50 states and territories, and we have a network of more than 1,000 MGAs or cover holders and wholesale brokers doing business on an open market basis. And without all of your support, of course, Lloyds wouldn't be the successful market that it is today. So I want to thank you very, very much for continuing to bring your business to the Lloyds market. And California, indeed, is our second largest state. It represents nearly 1/5 of the US premiums that are written by the market, and we are the largest E&S provider in the state. And here our major lines are property, energy, and marine. And we insure, and we're very proud to insure some of your biggest companies and enterprises, including the world's best-known technology companies, your museums, wind farms, and wineries that are based in the Golden State. So a long list of clients that we're very, very proud to work with. Here in California, we've got 127 cover holders, and we greatly appreciate those partnerships. They're an absolutely vital provider and source of business for the Lloyds market, and of course, all the wholesale brokers that we work with, and I know that some of you are here today. So welcome. So you can see that the partnership between the US and Lloyds has been very certainly successful for Lloyds, and I hope all of you think it's been successful and it's working for all of you. And I know he's not here today, but I would like to thank Hank Watkins, who's the president of Lloyds America. He's based in New York City, and I know he's not here today, but I want to thank him for the excellent work he does in leading the whole team, which we have enlarged over the years, obviously represented here by Rich McGrath, who you heard from. But we have 7 US offices around the country to make sure that we can continue to grow and, importantly, make it as easy for you to do business with Lloyds as you might find it to do or to deal with other carriers. And, of course, that unique bond between Lloyds and the US started many, many, many years ago. And we've got a sort of shared history. And it was that visionary Lloyds underwriter, Cuthbert Heath, who wrote the first Lloyds reinsurance policy of American risks, and that was actually for a British company that was doing business here. And then during the 1870s and 80s, it was Heath who established Lloyd's presence here in the US. And it was right in San Francisco that, of course, our reputation was forged, and perhaps you learn about that as you learn about insurance here. What the devastating fires unleashed by the 1906 earthquake did and how Lloyds responded to that, saying that we would pay all claims actually that arose out of that earthquake, even though there was no such thing as earthquake cover in those days. And I think that really has helped cement our relationship and our reputation in this market. And of course, since then, we have stuck by and always been there, whatever catastrophe has struck. We've been through 9/11, we've been through Hurricanes Katrina, Rita, Wilma, and of course, Superstorm Sandy. And right now, we're doing everything in our power to help support those impacted in Texas, Florida, and of course, throughout the Caribbean by those devastating storms, Harvey and Irma. And of course, right now we're watching Jose, wondering where that's going to hit and what damage that's going to do. And then, of course, Maria coming rapidly behind. And it's so important now that we really start fulfilling all of our promises. And even before people have really ascertained what damage they have, what claims they might want to make, we want to be there, helping support them, help support businesses and governments get back on their feet as quickly as possible. So we've been working hard. We've actually already been paying out claims on Harvey, and we are certainly committed to see what else we can do. We are working with the Insurance Industry Charitable Foundation here, which we've contributed to, and we're assisting in terms of their Harvey Disaster Relief Fund. We're working with the American Red Cross, and we also support a charity called Red R, that also provides assistance when things go wrong in terms of helping people get their lives back. In the Caribbean particularly, helping them to build shelters so that they've got somewhere safe. Well, we don't know what Maria will do, but so safe in the meantime. So we do try and always go that extra mile for all policyholders. And just here in San Francisco, just one little example I wanted to touch on was post 9/11. When we were only one of 2 insurers to quote on an affordable price for insuring the Golden Gate Bridge. And we did that without excluding terrorism cover, despite the heightened risk. And that's because we've worked with you. We know that we can have long, trusted relationships. And we understand that it's got to be both sides who win out of those relationships. And there are times, particularly when we really need to, I think, work more creatively in cooperation and joint coordination, and where sharing is absolutely vital. We've used the CalQuake as a sort of foundation of that, and now have completed an exploratory phase of this project, which also included a workshop in LA working with the California Earthquake Authority. And we really see this as certainly a desire on our part to be able to work more closely together and to see how we can explore how we can all gather intelligence together, making it better or easier, or we're more responsive when disaster strikes, but also help people understand the benefit of getting the right coverage. And I know we will explore that a little bit later on this morning. And natural catastrophes, they are an age-old peril. Since the 80s alone, we're seeing the number of registered weather-related loss events tripling. We're adjusting them for inflation, but the annual average of natural catastrophes was about $10 billion in the 80s. Now it's about $50 billion. So that just goes to show what's happening in the world with natural catastrophes. And while we know that, and we've talked specifically about this as the insurance sector, about the sort of benign claims activity that has been recently, I think what we're seeing now, exacerbated by the rising temperatures in the sea, what that is actually doing now for natural catastrophes. And we looked at what climate change and what rising sea levels did for Superstorm Sandy. And just an 8-inch rise in the sea level around that tip of Manhattan meant that the losses were 30% higher than they would have been if that sea level hadn't risen. So we know that there's a huge threat out there from climate change, and that's one of the issues that we are obviously also trying to address as a whole insurance sector. But of course, those are the old perils that we've been living with for many years. But what about the future, or what about the current new perils that we're all facing with? There are new and rapidly developing threats on the horizon. We're becoming more connected. Technology is changing the way we all live, the way we all work, the way we all connect with each other. And a whole host of new threats then are rising to the surface. And these changing risks are being faced by all of the customers all around the world, and particularly therefore means the insurance needs are changing as those risks are changing. And over the past 40 years, digitalization has meant that the value of assets and infrastructure has shifted from the physical now to the intangible. And we've only got to look at the S&P 500 and look back 40 years ago and see what was making up the asset base of the S&P 500. Most of it was from tangible assets. 84% was tangible. Fast forward it to today, it's completely reversed. Now we've got 84% being intangible. So the value of those companies is now something that we can hardly manage to get our arms around and to understand. We know that many businesses today, they don't have physical infrastructure, whether it's Skype, Airbnb, Uber, many tech companies that have actually sort of started here and are just down the road in Silicon Valley. The assets of these companies are different. They're digital, they're data rich, their value is based on IT systems, intellectual property and reputation that, of course, with the world so connected today, can be damaged very, very, very quickly. So those valuable commodities of the past, sort of chemicals and fuels, they're now changing to a different type of commodity, data and services. And I think this is one of the things that certainly as risk managers of businesses and certainly as insurers, we're trying to work out, what is this going to mean for us? What is it going to mean for our product? How do we need to change to adapt to all of these new risks? Cyber security is on every board agenda. And we've also, of course, had some interesting events very, very recently that are affecting millions and millions of people in one go, just one event. And then the changing economy, the sharing economy. This is something else that's really, really going to be changing the way that we as insurers look at risks. But of course, we also want to think about changing challenges into opportunities. So I hope we get some discussion going this morning, perhaps challenging insurers as to how we're not adapting to the new risks, those new sharing economy risks, but also perhaps how we can actually and are actually already working with these new firms. Lloyds hosts the insurance protection for Airbnb and reinsures Lemonade. So hopefully we're thought of as one of those insurers that's actually at the forefront of adapting insurance products to suit the changing needs. Now, in terms of the size of the overall sharing economy, a recent report found that worldwide there are now 17 companies in the sharing economy, each worth more than $1 billion. They've got 60,000 employees and $15 billion in funding. And that was from last year, that report, so I'm sure the numbers are rising. TechCrunch recently reported that Uber's market value was estimated to be about $50 billion. So if this is accurate, its current valuation is higher than a substantial number of S&P 500 companies. And of course, I can't mention Uber without mentioning its biggest competitor, Lyft, who may not be so global yet, but we'll hear more, and Lyft is also insured by Lloyds, but we'll hear more from Melissa Gale later on a little bit of the challenges that they're facing. And I'm, of course, excited to learn about all the autonomous cars, or semi-autonomous cars anyway, that are going to be here in the Bay Area by the end of this year. And I hope perhaps next time I'm here to be able to try them out. And I think it's very interesting when we think about the sharing economy and how technology is changing everything. One of the things that people often talk about is talent and what it's going to mean for jobs. Well, just thinking about some of those new sharing economy firms and think about how many people they're employing, 60,000 people, I don't think that there's a fear around how jobs will be changing. I think we just need to be aware that jobs are going to be very, very, very different in the future. And obviously we need to make sure that people are going to be skilled up appropriately from that. But I think there is something that we do need to think about, which is regulation and legislation actually keeping up with what's happening in the world, and particularly around these sharing economies. A recent PwC report estimates that sharing economy revenues are set to grow at 25% annually over the next decade to reach $335 billion by 2025. And just looking at the US, the same PwC report found that 44% of US consumers are familiar with the sharing economy, and 19% of the total US adult population has engaged in some form of a sharing economy transaction. So that is the future, and we need to make sure that we all move along at the same pace, and particularly ensure that regulation and that legislation keeps up with us. However, one interesting piece of research came out was that 69%, so out of that research that PwC did, 69% of those familiar with the sharing economy don't trust the companies. So until they're recommended by friends or a family member, they are very unlikely to use them because they don't trust them. And one way I believe, of course, that trust can be addressed is perhaps through insurance. Because also we've done some research around the sharing economy to really try and understand consumers' perceptions of some of these new businesses, and certainly some of the business perception of these new firms. And they're saying that actually, when there is insurance coverage involved, so if a firm has actually gone out and bought some insurance, they're more likely to be trusted. Now, we don't have all the final results of our research. We will be releasing that later in this year. But it did say that the research so far has found that more than 90% of consumers of the sharing economy believe that if there is some risk protection for the users, so they're not left high and dry if something goes wrong, the consumers will be trusting them. And when we included business travellers in there, and particularly sort of travel directors, we said, how likely are you to allow your employees to use one of these, sharing economy providers, whether it's, with the car, transport, whether it's with accommodation, they said that if there was insurance backing these businesses, they're much more likely to allow their employees to have it a policy within their firms that their employees can use them. So I think there's something that we can learn here about how insurers can work together with the firms to give that trust factor to the customers and the consumers so that they'll actually be willing to use you on a larger scale. So I think there is an opportunity for us to work together, but I'm also aware that we need to react and respond and be proactive in terms of the type of insurance products that we're able to offer you, and we need to continue to be innovative in this sphere. Now, if I just think about Lemonade, the peer-to-peer insurtech company, this is one of the examples. As I said, Lloyds is backing it, and I'm sure some of you are very familiar with it. I'm not sure whether it's actually up and running here. I think it might only be in New York State at the moment. But it is an interesting way of including people perhaps who didn't trust insurance, adding that sort of charitable element to it, saying, well, if there's any surplus left over from all your premiums, it'll go to some charity of your choice. And I think this is just a very interesting concept for people to think about, particularly some of the disruptors these days, and certainly some of the headlines around some of the fintech startups and things that have been going on, and how maybe some of the reputations of some of these firms are being a little bit tainted by some of the cultures and activities that are in them. I think there's something we've got to get right here as we're doing new things and trying to engage with people, building that trust and making sure that actually what we're going to be delivering and what we're saying we're going to be delivering is actually what we're going to be delivering, because trust is going to be a very, very important factor of doing business going forward. Now, I did just want to touch on cyber risk, because there have been some very global, actually, headline-grabbing cyber attacks recently, and Lloyds, being the largest insurer globally of standalone cyber, I couldn't not help but talk about it. We do believe we've got a 25% market share of a rapidly growing market. Lloyds writes about $1 billion of cyber premium at the moment. So that's quite a chunk. 80% of it, though, comes from the US. That was closer to 90%, but as regulation has been put in place in various other parts of the world, we've seen cyber security be put on the boardroom agenda, and therefore boards are really challenging their risk management teams, their IT experts, to think about what protection needs to be bought. So we've seen a dramatic increase in cyber inquiries. But of course, like any new risk, we're still grappling with making sure we can understand what it can cost us, how we can price it appropriately, what sort of coverage firms need. And every time there's an event, we want to learn from it, bring that data into our modelling so that we can try and assess the actual costs of the cyber threat. You will probably hear different views about whether the insurance sector should take on some of these risks. Just from a Lloyd's perspective, I want to say that we believe that insurers should be taking on some of this risk. If we're always handing it off to some government authority, I think we're failing in our duty to provide support and protection for society at large. And every time a new risk comes along, if the insurance sector runs away from it and doesn't take it on, I'm not sure we're really fulfilling the social purpose that we have, which is to enable humans to progress, to enable countries to move forward and invest in the future. So from a Lloyd's perspective, you'll certainly continue to hear us wanting to take more of these new risks on. We just need to work with buyers of it, the broking community, and certainly experts to understand some of this risk. So there's no doubt that we live in a rapidly changing world. Natural catastrophes growing, more severe, but obviously those man-made risks making our lives increasingly more complex. But it's our business. We're here to help shoulder those complex risks, enable advancements across all sorts of business sectors. And I'm really excited to be here to learn a little bit about from right where some of the new things are happening, some of the disruptors are based, to learn a bit more about how we can work with all of you here in the US to make your businesses more successful in the future. So thank you very much for listening. I look forward to the questions later, and I will now hand back. Yes, I'll hand back. Thank you. Thank you very much for listening.
Thank you, Inga. Well said. I'm particularly struck by your final comments about insurers getting into places, and if we don't, government taking it over, and certainly two of our panelists can speak to that. In a previous life, I spent a lot of my time working on flood insurance and terrorism insurance, both of which is a tug and pull between government programs and private sector. So that's a very real present. In fact, there's flood bills pending in Congress as we speak. So very relevant topic.